Good day and welcome back to another episode of the Personal Finance segment. We're here with our guest, Mr. Ross again. Hi Ross, how you doing?
Hi, Danny. Good morning. Yeah, thank you very much again. And let's living interesting times. So let's try and delve our way into trying to start to make sense on more, things that matters like money.
Yeah, I think at the time of the recording, it's the 24th of July, and Cupcake, as the media calls him, has just addressed us again. Very interesting times.
Yes. I just, there we got our kids back again,
Yeah, for another 4 weeks.
all back to try and homeschool them and, all that type of fun stuff. But my personal philosophy is, it's a lot of people talk about the new normal, and I don't think there's something like a new normal. It's the world changed and we have to adapt. I think that's more the simplistic way.
Growing up, would you ever think that you'd have to be a teacher doing homeschooling? So how's that going for you?
No, it's not going good at all. I now know, it's like homeschooling is not for us. And I think the kids, the way they teach kids nowadays are different than they did in our days, so learn languages is easy, but if it comes to maths and stuff, they learn in a different way.
Yeah.
And if we start try and help them, we actually are breaking the fundamentals on how they taught them, so. But we're fortunate, if you've got electronic communication, there's a lot they can do, so.
Are you teaching any subjects at home? So do you take any subjects, and how's your experience been?
No, I just teach them how to work with money,
That's great. It's a good start.
Every time he asks me a favor to do something, you have to pay me, and then if he do something, then I pay him.
Transactional analysis. That's exactly the way to go.
Yeah,
everything has a cost. There's no free lunch.
Yeah, and our cryptocurrencies, buying vouchers for games.
That's getting early adapters in. Opposite to you, I'm guessing. All right. So in the last podcast, we spoke about ETFs and unit trusts. But I kind of want to get into like a bit of things that I've been seeing, like for myself, when I do a bit of investing, and like start off with emotions, handling your emotions while like investing. So when the market's not doing so well. So, if we put into perspective current times, we're in a really volatile like market system because everyone's like kind of like not sure what's going on. So there's a lot of volatility in the prices. So one day your stocks could be doing well, one day your stocks aren't doing well. So like, how do you actively like manage that, and what do you do to keep yourself more disciplined when looking at your portfolio?
Randy, very interesting and topical thing on emotion. I think, it's a reality in terms of, and I think that's where a space where we operate in terms of advice and mentoring and that type of stuff in terms of investments. I think that's the biggest risk of any investor, is the emotional side of it. And I do think the only way to really, you always have the emotion and the fear and that type of thing. I think for us, I think if your horizon, we spoke on a different episode, spoke about your objective and your horizon. I think that's one thing that you always need to keep in mind is at the outset, what was your time frame in terms of how you're going through. So if you've got your 10-year time frame and you have your road mapped out and you understood from the beginning that you will have swings and roundabouts, then you tend to, if you say you look at your portfolio and, oh no, it's 10% down and tomorrow it's 10% up, you must just always bear in mind, and I think that's the way how to start to think about it, is if it's 10% down, surely it would make sense to buy more. So if you did your analysis
and like you believe in
say,
it,
the thing is worth 100, but you can buy something for 80, and tomorrow it's going up to 90, and you say, I made 10%, now it's coming back to 85, and you say, I lost 5%. but you were happy when you bought it at 80. So you should be okay whether there's roundabouts up and down. So I think that's the main thing. It's also a psychological, call it an exercise I think that you have to go through as you start off. Initially, you are fearful when it's up and down and you lose 10%. And I think if you stuck to your process over the years, you start to become less emotional about the up and downs. Initially, you will be, but it's like, it's a new thing that you experience of losing money. And what I always say to clients, and I think that's the crux of it, is you must always bear in mind your profits or losses is only paper profits and losses. So people phone me and say, "Oh, I got my statement back, and did you see I've lost 10%?" And I said to him, "Listen, that's a snapshot in time. It's only on paper. The profit, if you double your money, it's only in paper. You will only realize it once you sell it. Then you realize your loss or you realize your profit." So I do think that in terms of the emotional side of it, I think if you go in and you understand that will be your biggest risk, is to cave into the emotional side of it. And I think it goes per se like, cryptocurrencies, you start at 5,000 and 2,000, and then it went up, I think, at stage for Bitcoin to about 18,000, so then people want more, so that's the greed and the fear side of it. That's the two main risks for any investor, is either the greed side of it or the fear side of it, so you'd have to train yourself to don't cave into that.
So I think something that you mentioned there was really important, is that cash is king, and like the losses you're looking at or the gains you're looking at, it's on paper. It's like accounting. It's just it's what goes into your financial statements, man. But like what you really care about is that cash flow statement, and that's kind of your beliefs. We spoke about that in the first episode. You always like cash is king. Let's sort that out. So, or if you're what I'm getting from this, and what I'd like to draw to use, is that just keep your goal in mind, and that will help you stay disciplined. So if your term is 5 years, if you're down 10% in the first 30 days, I mean, your goal is you still have a lot of months, left. You have 59 more months left.
Yeah, and I think that's the point. I mean, one of the great principles that I was taught or experienced over years is, and doing transactions, I think that's the point when you start with investing, is doing your homework in terms of the price you pay up front. And I remember what a person once told me, that there's one thing that you can never recover from, and that's when you pay too much. And I think that's the principal point. If you pay too much for something, i.e. more than the underlying fundamental value, and it resets to the true underlying fundamental value, you cannot make up that difference, because the pricing was either pushed by market forces to too high, and it resets to the underlying value. And I think we spoke about it on a simplistic way. Say, for example, your house. A lot of people, they buy a house, and the price you pay, you must always ask yourself, truly for a house, the true intrinsic value should be, the brick and mortar. What does it cost me to rebuild my house? That should, in essence, be the true value. So if you pay too much because you like the house or the view is great, that's the emotional side of it.
You're paying for atmosphere, that bit.
So if you make sure that you don't pay too much up front, then you will be okay with the up and downs, so.
Yeah, that's something. It's like Tesla. People are like really like keen to get on Tesla now, but I'm like, look at how high it's up now, and it's like now it's going into like just a lot of momentum, but like, I mean, the good time to get into like a stock is like when, like, I think, there's something that I was reading and I was watching, I think, a while back, and it's like, if you're doing a lot of momentum investing, and like you're gonna invest in stocks solely based on like that everyone's on that pattern, on that trend. It's like if you're catching a trend that people have been jumping on for like 3 months, it's a bad time to go on it, because like people have been on that trend for like 3 months, you know. So what's your take on momentum in like investing?
I think that's, I mean, my personal, I'm more a value type investor, and the moment you understand the fundamental of true value investing, and I'm not talking about absolute value, just buy it because it's cheap, you know. I'm talking about buying because it's less than the intrinsic value. So inherently, that's where my philosophy lies. So then, per se, it means that you try and avoid any of the momentum stuff. And I'm always saying to people, you know, momentum play is like a short-term play thing. You bet on it, you know, you bet that it will keep on going. And without having all the fundamentals in place. And I think Tesla is a good example. You know, you suddenly now need to say, okay, but what needs to happen for that price to make sense? Obviously, they will have to try and corner 80% of the market, you know, so to try and, because people are now putting so much hope in things that still need to happen, you know, it's still, and it's a demand and people, there's more people that want the shares and less that want to sell it, you know, so inherently and I think that's leading to the next question that you ask in terms of investing is, but do you need to bet on one share, or do I rather need to have 5 shares? And then you start to say, okay, but I need to start to diversify, and diversification is a cornerstone of investment, you know. And the simplistic way is, like I say, if you've got one share and the share lose half of the value, then you end up with 50%. But if you've got 10 shares and one of them half, you know, the impact is, you know, a lot smaller. You know, and I think that's the point of diversification. If you have a long-term investment horizon, you need to have diversification. You know, you need to spread your risk, because I think in the first episode or the second episode, we spoke about risk and how we define it. And I always said risk for me simplistically is the chances of you losing permanent capital. You know, you've got 100 Rand and you lose 50%, you only have 50% left. But and you have to start spreading that risk. And I think diversification is making your ride smoother over the long term. Less ups and downs, less, sure, you give up upside. And, you know, diversification for us, looking or managing other people's money, is the crux. You know, you need to manage people's right. You know, if they want to go, I always use the example, you know, if you want to go to Cape Town, you know, you tend to say, dependable on the client, you say, okay, I want to get to Cape Town. The first thing you ask the person is, but what's your time frame that you want to get to Cape Town? Now, surely if they say, listen, I need to get in Cape Town in 2 hours. So, okay, well, then the plane is the easiest and the quickest. But we know life doesn't work like that. So you say, listen, I want to get to Cape Town. You know, you can take the highway, the easy road, or I can let someone take all the gravel roads and dongas and things like that. And, you know, so we try and make the ride as smooth as possible. And diversification
helps.
Well, it's the only way to do it, because you can understand if someone worked for 10 years and you lose half of his money, how long does he need to work again to make up that lost time, you know? So, and diversification is the biggest way to get there without putting your money at risk.
And I think on that note, I just want to go into the segment is, well, then we were talking about risk, you know, and you know, now you're talking about return as well. So then how do we now, like, what would you say is like an optimal number to manage risk and return? You know, I think we went into a story prior to the podcast where you spoke about, you know, just managing where you had like a dummy account portfolio where you like place a number of shares, and then can you walk through that story?
Yeah, it's also, but I'm trying to keep it as simple as possible. And I mean, it's the point that we try to get. I mean, there's lots of studies. The listeners can Google it. What is the ultimate share portfolio? And I think that gets you to the number. Now, the point is, they did a study in terms of trying to figure out, and we started with 1 share, and now if you have 2 shares, and if we say the ultimate risk that you can take for a long-term investor is to invest in, and say, the MSCI or the JSE ETF, that is the market. That gives you the market. So, but that's like the broadest range of shares. If there's, for example, 100 shares in the listed space, then you will get the average of all the shares. And you say, okay, now, if that is the level, call it the baseline, and we, just for this example, if you just invest in an ETF that gives you the market, say you get 10% per annum over time. Now, surely, if you say, I've got 1 share, now, you must get rewarded for that extra risk. And the question we start to ask is, okay, so how much more must I get for that ultimate 1 share risk? Now, I mean, we don't know that number. You can probably say you must probably earn 200% per annum to make up that risk for that 1 share, because you can lose half. And I think that's where they went to a point to say, listen, the ultimate risk return that you can get out of diversification of shares is that you must have around about between 18 and 21 counters. So let's cut it in the middle, say 20. You need at least 20 shares in a portfolio that gives you that balance of the best chance of outperformance with the least chance of losing money. And I think that's my point always that I make to people. And then you start to say, okay, but who has done it? And I think that's who has run that ultimate portfolio. And I think that's where we got with that dummy portfolio, because I wanted to get to the answer on, if a fund manager gives me 10% per annum, but the market also gave me 10%, surely the manager should give me more than that. And I think we got to that. And it's the same in terms of your diversification of your portfolio, where you say, okay, so if someone run my share portfolio for me, he needs to outperform the market. And my question that I wanted to ask, but nobody knows by how much. Could it be 2%? Or 3% more, or 4% more, or 6% more? And that's where the dummy portfolio we can do in another episode, but I mean, it was interesting. It was just my way of saying, listen, if this is the best, so I just took 18 shares and just ranked them, give them equal money, and got to a number, and then said, well, if someone ran my money, he must at least do that or better. But it got to the diversification. I think for your listeners, a lot of people that start to want to invest, I mean, you start to buy 1 share or 2 shares or 3 shares and that type of thing. And as you go along, obviously you need to understand, if one of your calls doesn't work, the downside will be a lot. It's close to a third of your portfolio. And I think we spoke also why, personally, I'm not a big supporter of share portfolios. So it's a great way to learn yourself, but it's an interesting ride, in terms of if it's your own money, and that you want to save for retirement, so.
Okay, and then I think on that, can we go into like how do you determine like the type of investor you are? Like you just spoke now recently of you being a value investor, and I was speaking about like momentum investing. So then, how do you make that assessment? Like what type of investor you are? Like when you're starting out, like how do you know what should you look for? Do you have any clues on that?
I think that's every person is. I've been exposed to, call it the Warren Buffett style of investing, which intuitively for me make a lot of sense. It makes a lot of sense for me to say, listen, don't buy something and overpay for it, because I tend, if you read the Warren Buffett stories and Benjamin Graham philosophy of value investment, I truly believe that's only the real way of actually giving yourself the best chance over the long term.
Yeah.
And I think I believe in that philosophy, and I think it's proof that that's the way that a lot of even business people, you get the person that gets wealthy by luck. But I think if you consistently want to do the same thing over and over and over, the only way to get there is not to pay too much for any of your securities that you buy. Otherwise, you tend to feel, it's a bit of a bet. And it takes you to the point of, for investors and maybe your listeners, a lot of people say, okay, but what is one of the foundations of value investment is looking at the PE ratio, the price earnings ratio of a company. And my simplistic way, I always say to people that you must just bear in mind, because people say, okay, but why do you say it's expensive? Now, one of the things is using your price earnings ratio of a company. And if the price earnings ratio is 10, and then people don't really factor in how simplistic it is to actually say, because it means if I pay 100 Rand for a company, the price earnings ratio means that it will take 10 years of that company's earnings without them growing to get your 100 Rand back. Because obviously you put money in a business because you want to get profits.
Yeah.
A lot of people say they think they invest in a company and they want the 100 to becomes 200. You invest 100 Rand because you are trusting the management to give you profits. So that 100 Rand is, I want every year some of the profit. And a 10 PE means 100 Rand, you will get 100, you will have to wait 10 years to get your 100 Rand back in profits. And so I said to her, okay, so if a company's price earning ratio is 50, are you going to wait 50 years to get your 100 Rand back?
So
Surely not.
Yeah, so I think your approach then would be different. You'd be looking at growth, capital growth then.
Sure. But but it's still, the only way to get your money back is if there wasn't markets, is wait for the profits. Ooh. So if a company's price earnings, I don't know, I haven't looked at Tesla's lately, but say it's 100 or 200.
Yeah, it's like 150 or something like that. Yeah.
So you're going to wait for 150 years. Now, what must happen for that 150 PE to become 10? They should have massive, massive returns year on year, and probably grow it by 50, 60, 70% of earnings consistently. And then you should ask yourself, but is it possible? Realistic? Yeah. Is it realistic? And as a value investor, you just say, and it's me, I'd rather pay 100 Rand for a business that I see are delivering good cash flows, they're growing their profits, there's a fundamental underlying value to the business, then you get the more certain that, I will get my money back in the next 10 years. And if they keep on growing or they're doing fantastically well, then maybe I get my money back in 5 years. And once you've got your money back, then you start to say, okay, now the rest from now is upside. Then you've got your capital, your 100 Rand, and your earnings and that type of thing. So I think that's the way that makes, for me,
more sense.
Just more sense, you can sleep at night again.
And to all our listeners, thank you so much for tuning into this week's episode. If you have any requests, any questions for Ross, I'll leave his LinkedIn profile link in the description below, and his email as well. If you have any questions that you can shoot over his side, and if you have questions for us, remember you can send it to any on our email. Will also be linked in the description box. And you can also contact us on all our social media platforms. Remember to subscribe to all our social media platforms. Our handle is @FinChatCo. We have a weekly newsletter that we release every single week, so subscribe to that. And remember to give us a favorable rating on all your podcast platforms. From FinChat, the personal finance segment. We'll see you next week. Thank you.